this intensive revision about 6 weekends ago. As if we were not going to finish, but here we are on the last day, finalizing what we started. We give thanks to God for spreading our life. When we started, we tried to cover as much as possible in terms of what we did and what is contained in the SBR syllabus. 2 weeks ago, we did a revision of group accounts, and I brought in a pager to explain how to answer question 2, especially with regards to professional ethics. And the very question we looked at that day, or the set of questions we looked at that day, included that question 2, which we explained. This morning, I'm starting with same question 2. I sent you the questions we are using for today. I'm sure individually you will have seen it on your platform. So the next thing is for us to go straight to the point. Because you noticed during the last class, I made 15 days ago, that due to time constraint and the need to explain, we could not finish everything we planned to do that day. So today, I will try as much as possible to be straight to the point, such that all the questions I've sent to you, we're able to answer all of them. There will be room for questions to be asked. Always raise your hand. I will call you. If you stay too long raising your hand, it could be that I'm unable to see you. You can unmute yourself and speak. I know we have some people in our midst who never received lecture with us. I believe they've created a separate platform for you to join, and I believe you will have been invited to that platform, such that you will have seen the question as well. Having said that, I would like someone to help in reading this question 2. This is a typical question 2 in the exam, and this is where you see professional ethics. And I'm starting with this simply because this was the last thing I rushed to explain then in that other question we solved. So I would appreciate if someone is able to do this. Anybody, please.
Okay. Please, can you scroll to the beginning of the question, please, sir?
Okay. And it appears this thing is slow.
Okay, I can see it now.
Okay.
Okay, question 2. Habi is a company which conducts business in several parts of the world. Related party transaction. The accountant has discovered that the finance director of Habi has purchased goods from a company, Harbite, which the director jointly owns with his wife, and the accountant believes that this purchase should be disclosed. However, the director refused to disclose the transaction as, in his opinion, it is an arm's-length transaction. He feels that if the transaction is disclosed, it will be harmful to business and feels that the information asymmetry caused by such non-disclosure is irrelevant, as most entities undertake related party transactions without disclosing them. Similarly, the director felt that competitive harm would occur if disclosure of operating segment profit or loss was made. As a result, the entity only disclosed a measure of total asset and total liability for each reportable segment. When preparing the financial statement for the relevant year end, the accountant noticed that Harbite has not paid an invoice for several millions dollars, and it is significantly overdue for payment. It appears that the entity has liquidity problem, and it is unlikely that Harbite will pay. The accountant believes that a loss allowance for trade receivable is required. The finance director has refused to make such an allowance and has told the accountant that the issue must not be disclosed with anyone within the trade because of possible repercussions for the credit worthiness of Harbite subsidiary fair value. Additionally, when completing the consolidated financial statement, the director has suggested that there should be no positive fair value adjustment for recently acquired subsidiary, and has stated that the accountant's current position is dependent upon following the instruction. The fair value of subsidiary is 50 million above the carrying amount. Okay. Above the carrying amount in the financial record. The reason given for not fair valuing the subsidiary net asset is that goodwill is an arbitrary calculation, which is meaningless in the context of the performance evaluation of an entity. Goodwill impairment calculation. Finally, when preparing the annual impairment test of goodwill arising on other subsidiaries, the director has suggested that the accountant is flexible in the assumption used in calculating future expected cash flows so that no impairment of goodwill arises, and that the accountant should use a discount rate which reflects risk for which future cash flows have been adjusted. He has indicated that he will support a salary increase for the accountant if he follows his suggestion. Required. Discuss the ethical and accounting implication of the above situation from the perspective of the reporting accountant. Professional mark will be awarded in question 2 for the application of ethical principle. So total 20 marks.
Okay. Thank you very much. I don't know whether you can hear me clearly, because as I'm trying to move the PDF document, my second device is showing that it's not moving as fast as I'm moving it. Is my voice very clear? And are you able to?
Yes, very laudable.
Okay, thank you. Okay, this is a question 2. And you see that in this question 2, accounting standards were examined. I gave you something during the last class we had, that typically when you are dealing with a scenario-based question that involves accounting standards, The first thing is to identify the accounting standard. The second thing is to identify the principle in that accounting standard that is being examined, or principles if there are more than one. Then the next thing after that is to be able to recall those principles from wherever they are stored in your system. Then bring out those principles and apply them to the scenario. Typically, you start by stating what the standard requires. Then you relate them to the scenario you have at hand to ensure that you are able to discuss objectively how the transaction in question should have been treated based on what you have stated in terms of the principles of that standard. I put that in the Excel I sent across to you then. It's the same Excel I'm going to use today. It's just that I will be creating additional worksheet for any new question I'm going to solve. So in case you were not in the class, then you'll be able to see it. In this question, which accounting standards have been examined? I'm sure sometimes the examiner can be so clear in terms of wanting you to know the accounting standards he's trying to examine. If you look at the top of the first two paragraphs, we have related party transactions there. And from what you've read, you will have seen that IS 24 is being examined here. But it got to a point again that the examiner mentioned IFRS 8, operating segment kind of thing. So you should equally send your mind back to IFRS 8, operating segment, and what it requires. So it's not only IS 24 that is being examined there. And also here, you have the subsidiary fair value adjustment issue, where the director is of the view that the fair value adjustment shouldn't be recognized, despite the fact that there's an upward fair value adjustment. That is a requirement of IFRS 3, which is group related. So this shows that group IFRS 3, IFRS 10, or related standard can still be examined in question 2, despite the fact that it will always be examined in question 1. Again, you've seen that the third section of this question talks to goodwill impairment calculation, which is partly IFRS 6, but something we did when we were doing group accounts. Although IS 36 is a separate topic, which I believe you did, or you will have revised as well. But it's not just impairment of any assets, it's impairment of goodwill. And remember, goodwill does not generate cash flow of its own. And as such, the same way you can subject other assets to impairment individually, provided they generate cash flows that are largely independent of the cash flows being generated by other assets, there is no way you can test goodwill individually. Once it's for impairment, once you say you are testing goodwill for impairment, it means you are testing the CGU, the cash generating unit, to which that goodwill belongs. So there are two acts in this question, as usual. One is to discuss the ethical implications, and the second one is to discuss the accounting implications. My suggested approach is based on the heading the examiner has used. Discuss the IS-24 and IFRS 8 accounting implications first. Then come and discuss the second matter, which is the not recognizing the fair value adjustment. And after that, come and discuss the third one. That is the accounting implications. Then when you are done, if you look at it, in all the three sections in this question, we have ethical issues being mentioned or discussed. You don't need to discuss those ones separately. So when you start professional ethics discussion, then you are discussing the ethical issues that occur in those three sections of this question. And you conclude. And when you are concluding, again, just like we saw in the question we solved 15 days ago, this is a game between an accountant and the director. Someone posted on the group chat that the director will always be wrong, and the accountant will always be right. And based on that, that helps to determine the direction of how this question should be tackled, the professional ethics part of the question. Of course, from many questions that you've seen, and the one I've seen as well, that has always been the case. But please don't go to the exam hall with that mindset alone, such that when you see something different, you are not going to stick permanently to that notion that the director will always be wrong. In most cases, from what we've seen, that has been the trend. That has been the trend. But what if you see another question tomorrow and the director is right and it's the accountant that is wrong? Okay, so looking at the related party and IFRS 8 part of this question. It says, the finance director purchased goods from a company. The name of the company is all right, which the directors jointly own with his wife. Jointly owned with his wife. And the accountant believed that the purchase should be disclosed. However, the director refuses to disclose the transaction, as in his own opinion, the transaction is done at arm's length. It's done at arm's length. So based on that, he feels that that disclosure is not necessary. He feels that it will be harmful to the business, and he believes that the information asymmetry caused by non-disclosure is irrelevant, as most entities undertake related party transactions without disclosing them. And he also felt that a competitive harm would be done to the business if operating segment profit or loss was made. As a result, he only feels that the only thing they should disclose is total assets and total liabilities for each segment. No other disclosure is necessary. What do you think about this? Accounting implications now. Accounting implications. What do you think about this? Tokwe, go ahead.
Okay, so I think according to IS 24 now, related party transactions, any transaction between those that are in control or have significant influence over an entity should be disclosed. That's between them and the entity now should be disclosed in the financial statements. So that purchase should be disclosed since the director is a person who has influence and is involved in the day-to-day decision making of the business. And then for the operating segment, the intention not to disclose it, it's a means to achieve a particular result or to misrepresent um, the financial statements. And I feel it should also be disclosed so that the financial statement is not misstated. And then for the information asymmetry caused by non-disclosure, it's saying it's irrelevant. But in this case, we can't really say it's irrelevant because like some investors are actually looking for that kind of information to be able to drive their decisions. So that's what I think.
Okay, thanks, Dr. When you were discussing, you were trying to dwell on professional ethics part of that question. Given that you are still going to write separately on it elsewhere, given that what we are dealing with for now is accounting implication, I would advise that you limit the extent of discussions involving ethics so that you have enough to write and you won't waste too much time here. Someone was trying to raise her hand again, but the hand disappeared. In case you are the one, if you are still there and you still want to talk, can you quickly do that?
Tokwe has mentioned my point, so that's why I raised my hand down, so that we don't say.
Okay, thanks.
Okay.
Okay, so but please look at this. IS 28, the name is related parties, the related party disclosures. That standard is purely about disclosure, right? But in terms of focus, you can group the focus of that standard into two areas. One is it helps to identify related parties. It helps to identify who are related parties. Then the second thing it says is once you identify related parties, if there are transaction and balances that the reporting entity has with those related parties, then you should disclose them and what you should disclose as well. Never forget those two focus areas of IS 24. So the first thing you should discuss when you are discussing this thing is to even identify whether this director is a related, that company, which is all right from which this director has bought some goods, whether it's a related party to ABI. ABI is the reporting entity here. The other entity from which the director has purchased goods during the year is called all right. Is it really a related party? If yes, on what basis? You should be able to discuss that. You should be able to mention that there is a related party. It is only when you have identified the related party that you should now say the fact that these things should be disclosed and disclosed regardless of whether or not the transactions are done at arm's length. So from the perspective of IS 24, an entity that is controlled by the director sitting in another entity or sitting in the reporting entity. The director of a reporting entity controls another entity, either individually or jointly with someone. Jointly in this case, is he a related party? From what IS 24 says, is all right a related party?
Yes, it is.
So you should be able to disclose that. You
Yes.
should be able to discuss that it's a related party on the basis of the fact that this director controls the other entity. Then the second thing you should talk about is then if it's a related party, the standard IS-24 requires that transactions and balances, including relationship. In fact, the relationship first, transactions, then balances. Those things should be disclosed. So the relationship should be well disclosed in the financial statement according to IS-24. The transactions that took place during the year, which is the goods purchased and the value of the good, must be disclosed. The nature of the transaction and the amount of the transaction has to be disclosed. Then if at the end of the year there are balances, maybe you are yet to pay all right, you equally need to disclose that fact. So that is a requirement. So not disclosing here will amount to violating the requirement of IS-24. So because that is a disclosure. And IS-24 does not give you the room not to disclose what are these things that are required, even though you feel that disclosing them will be harmful to your business. IS-24 does not give you the room not to disclose. So take note, identify whether or not this entity, all right, is a related party. Then tell the reason why it's a related party, simply because the director in the reporting entity controls the other entity jointly. And based on the requirement of IS-24, it is a related party. Then discuss the fact that relationship, transactions, nature and amount, and balances must be disclosed. And IS-24 does not give room for you or does not allow you or permit you not to disclose simply because you believe that disclosure will be harmful. If the transactions are truly at arm's length, then you are required to mention that according to IS-24. But if they are not at arm's length, then it would be inappropriate for that entity to have disclosed that this transaction has been done at arm's length. So regardless of whether or not the transactions are done at arm's length, those things that must be disclosed must still be disclosed. So that is the IS-24. Again, if you look at operating segment, the director is equally of the view that disclosing the profit or loss would be harmful. Maybe one segment has made a profit, the other segment has made a loss, but that has been masked by the fact that in the statement of P or L and OCI, there's no way you will see which segment has made a profit or loss, right? So that cannot be deduced by the users of the financial statement merely by looking at the statement of P or L and OCI. However, IFRS 8 requires specific disclosures when you have operating segments, even though it says that what you are to disclose should be based on what is regularly provided to the chief operating decision maker. There are some specific disclosures that must be made in the financial statement when you have operating segments. And one of them, according to IFRS 8, is the segment profit. So if there are two segments, for instance, segment A, segment B, then you need to disclose the profit made by each one of them, or the profit made by one, the loss made by the other, or the loss made by each one of them, depending on what each segment has. And if there's any adjustment intra-segment transactions, you need to eliminate. You need to eliminate such that, and these things you are disclosing in the segment, the total must tie. It must tie to what you have already presented on the face of statement of P or L. So profit is one of the things that is required to be disclosed. In fact, depreciation, amortization are part of what IFRS 8 specifically requires that you disclose. Of course, it requires that you should disclose total assets and total liabilities, but that is not all. Another thing the standard requires is, it says, for non-current assets such as PPE, investment property, intangible assets, additions that occur during the year should be disclosed. Of course, in the note to the property, plant, and equipment, note to intangible asset, note to investment property, you will have disclosed that. But what you will have disclosed there will not be based on each segment. So here you need to disclose per segment and the total that ties back to those other notes. And this discussion should start with the fact that IFRS 8 requires specific disclosures about operating segment. What is an operating segment? The instances that it says that you can even combine segments for the purpose of disclosures. All those facts should be stated there. Israel, your hand is up.
Yes, sir. Well done, sir. I don't know whether it is just me. I know it's the lead.
Hello.
Can you hear me, sir?
You say you don't know whether you. Yes, yes.
No, I'm saying that whether it is just only me, I think you're a bit fast. That's what I'm saying. I know it's a revision class. I think you're a bit fast.
Oh, I'm too fast. You know,
yes, sir.
I would like others to equally comment on that.
Sir, you are fine. You are very fine.
So you're fine, no time.
There's no time.
So, maybe he's writing. You will send us the solution, so you should
I
just
not the solution.
Maybe he's writing. That's why
also available to listen
okay,
again.
So thank you for reminding us.
I'm in the minority. Thank you, sir. All right, continue, sir.
Okay, no. Just to ensure that you are fine, the recording will be available. That is one. Then secondly, the solution will be sent. Experience has shown that we end up not finishing everything we've highlighted today if I'm going to dictate or if I'm going to talk so slowly. Thank you. Comfort. Okay, you've lowered your hand. Okay, then if we move.
Hi, Mr. Jamu. Sorry, I actually wanted to unmute my mic. Okay, I have a question, and it's on the related party disclosure. I just want to confirm. Is part of the disclosure, are we supposed to mention that the transaction is at arm's length while disclosing, or it's not compulsory?
Are you supposed to measure the transactions at arm's length?
Are we supposed to include the fact that the transaction is at arm's length as part of the disclosures?
Okay, thank you. IAS 24 says if the transactions have been done at arm's length, that fact should be disclosed. In other words, if they are not at arm's length, then you can't tell us that they have been done at arm's length. So it only says that if those transactions have been done at arm's length, disclose that fact. I hope that is clear.
Yes. But if it's not at arm's length, do we say
you don't need to disclose? You don't need to disclose the fact that they are not done at arm's length.
At arm's length. Okay.
If you are silent, then people will know that they are not done at arm's length.
Okay. Thank you.
Okay, so when preparing financial statement for the recent year, the accountant noticed that Allright has not paid an invoice for several millions of dollars, and it is several millions. That means it's not a small amount. And it is significantly overdue for payment. An invoice, just one invoice, right? Just one invoice, several millions of dollars, significantly overdue. It appears that the entity has liquidity problem, and it is unlikely a liquidity problem. Okay, and it is unlikely that all right will pay. Unlikely that it will pay. The accountant believes that a loss allowance for trade receivable is required. Yes. The finance director has refused to make such an allowance and has told the accountant that the issue must not be discussed with anyone. Okay, that is a professionality part of it. Okay, so again, this is the requirement of IFRS 9, right? I didn't mention this before. We equally need to talk about that. This is a trade receivable. It has become overdue, significantly overdue, and they say it is unlikely it will be repaid. Definitely trade receivable, unless it has significant financing components, should be subjected to impairment using what we call the simplified approach. Using simplified approach, there is nothing like stage 1, stage 2, stage 3, because there is nothing like significant increase in credit risk being looked out for. So as a result of this, the standard equally permits the use of what we call provision matrix. So using that provision matrix, depending on the number of days that receivable has become due, so the loss rate you will apply will be different. However, in a situation where you are dealing with just an invoice that has become due, is significant in terms of the amount, become due for quite a while, and then we are being told that the debtor is experiencing significant experiencing liquidity problem and may not be able to pay. Of course, this amount, unless you are able to say that this is what you will use to recover it, maybe in terms of if there is any collateral, which I believe will not exist in the case of trade receivable, then unless they are going to use the entitlement of this director to deal with that, the impairment here is likely to be full impairment. It's likely to be full impairment. So impairment has to be done in line with the requirement of IFRS 9. So that is on that part. Subsidiary fair value adjustment. Again, when you look at this, what are they talking about here? They say additionally, Elizabeth.
Yes, sir. Good morning, sir.
Good morning.
Talking about this IFRS 9 you just mentioned now. I'm just thinking, first of all, this transaction is not right because it's a related party transaction. And I believe, even though the man said it was at arm's length, it wasn't done at arm's length. Now to come and start providing for it, whereas in the beginning it wasn't right. How is that supposed to be?
Elizabeth, what do you mean when you say it wasn't right? Do you mean that they should not have sold good to all right?
Yes.
There is nothing, no, there is nothing in IS 27 that says you cannot transfer with a related party. Sorry, IS 24. There is absolutely nothing there that says when you have a related party, are we together? Don't transact with them. There's nothing there. Or else.
Okay, what about due process?
What did you say?
Due process. You know, before you can give somebody to buy goods from you, there should be creditworthiness test and all that. What if all that was not done? That's why the director doesn't want to disclose it.
Fantastic, Elizabeth. All those files you should discuss them under professional ethics, right? But here, did you get the fact that all those due processes are not done? Are you able to get that here? Are you able to get that from the question? The answer is no. So what you are unable to get from the question, don't begin to, especially something that may not necessarily have too much value to you in terms of the marks. Don't discuss don't waste too much time on that. We've not been provided with the fact as to whether the due process has been followed or not. All we know is that goods have been sold to All Right, and All Right has refused to pay. Because the question is, when the goods were sold, do they meet the criteria of IFRS 15? If the answer is yes, the revenue should have been recognized. And if you have recognized revenue, then you have to recognize receivable. So the only reason that could have made you not to recognize revenue in the first place and the corresponding receivable is when the criteria of IFRS 15 are not met. And all those facts are not provided here. So don't go too much into that. Don't go too much into that. So impairment still has to be done as long as receivable has been done. Thank you.
Okay.
Kilani?
Yes, sir. Good morning, sir.
Good morning.
Yes, sir. Good morning, sir. Thank you very much for the explanation. Where I'm going now is that at the point of discussion, maybe we want to discuss a point, probably at this related party transaction now. To what extent are we expected, like this one now, is 18 marks. I may not know how the gravity of each of those standards being tested because they didn't split the marks. So to what extent, or like how many sentences do we expect probably to make? Like the video, something that they sent to us last week now, that we are saying 0.5 or each sentence on that. So to what extent can we come up with our response that will probably fetch us a better mark? Like maybe it's 17 marks. Are we expected to make like maybe 14 sentences, or how far can we go up so that we can meet up with the standard? And we are not going to raise unnecessary points that will not even count much for us. Thank you.
Okay, thank you, Kilani. In that video, I'm going to ask you a question. That video you say you watched, did they talk about the number of sentences you should write? Do they advise?
They didn't ask for advice, but as the woman was reading each of the sentences, was just allocating 0.5 mark, 0.5 mark. As you read another one, 0.5 marks. So what we know is the student has scored even much of the marks. So I just want to know the level at which you can advise us to, so that we not short ourselves or we not over waste our time.
Okay, thank you. Anyway, the solution I'm going to send to you, which will be that of the examiner, again, take note that solution is going to be much more comprehensive. I've always said that you are not expected to write as much as that for you to earn all the full marks. But the marks are based on points. What do we mean by points? That is why I said first identify the standard, then narrow it to the principles. Now, the principle being tested, once you understand it, there are points. There are points. You should be able to remember about that principles. Now, we have 18 marks here. The question is, how do you allocate this among the 4 areas? How do you allocate this? The 2 marks is for professional ethics. How do you allocate this? Now, let's say the 4 marks out of that 18 is for professional ethics, plus 2, making 6. Then the remaining 4 are 14 marks will be for the 3 different areas they've talked about here, right? Now, if you just from your own head, you divide this thing by 3, that is for the accounting implications now. That may be like, if you look at the section 1, there are many things there. There could be more marks assigned to that the first one that has to do with IFRS 9, IFRS 8, and IFRS 24. Maybe more of the marks may go there. It may not be equal. It may not be equal because for the second and the third one, what they are talking about there are not many. It could just be one accounting standard. So if in your head you allocate based on that, It is about the point. It's about the point and whether that point is well communicated. It's about each point and whether that point, when you identify the principle, you zero down on a principle, definitely you will be able to write more than 3 or 4 points. But don't go too much. Once you have talked about a point and you've communicated in a very clear language, it is that point that will be marked. It's not, but you know, some people, you've communicated a point. You are now writing an additional 2 or 3 or 4 lines, still say explaining that point, whereas you have well communicated it. That those additional things you are writing will not earn you any mark. So communicating that point, each point may just be a sentence, a line, or it could take you up to 2 lines, depending on what you need to write to communicate that point. What is key is communicating a point. And for each question or each principle you are looking at, there could be 2, 3, 4, or 5 points. If you can't remember, don't just keep on searching your head because time is ticking fast. Don't keep on searching. What you can remember, communicate in a clear language. It could be in 1 line, it could be in 2 lines, depending on how you need to write to be able to communicate the point. It is the points that marks will be attached to. And just the same way in the video, they were unable to tell you how many points. Exactly the same way I won't be able to tell you any points. It's a function of how many points are there in that principle that is being examined. I hope that cleared your doubts, or it's response. I mean, I've responded well to your question, Kilani.
Yes, sir. Yes, sir.
Okay, additionally, when completing the consolidated financial statement, the director has suggested that there should be no positive fair value adjustment. There should be no positive fair value adjustment for recently acquired subsidiary, and has stated that the accountant current position, that is ethics, is dependent upon following this instruction. The fair value of this subsidiary is 50 million the fair value of the subsidiary is 50 million above the carrying amount in the financial record. The reason given for not fair valuing the subsidiary net asset is that goodwill is an arbitrary calculation, which is meaningless in the context of performance evaluation of an entity. What do you think about this? What do you think you should touch? What do you think are the points you should touch here? Anybody? What do you think are the points? You already know it's IFRS 3 that is being examined, and the director is okay. Korede Dada. Go ahead and speak, Korede Dada.
Hello? Hello, can you hear me, sir? Hello?
I can hear you.
Okay. In accordance with IFRS 3 business combination, where a subsidiary is being acquired, the acquirer should compute goodwill and consolidate the financial statement of the subsidiary. And in computing the goodwill on acquisition, all identifiable assets and liabilities should be measured at fair value. Not doing this will lead to the goodwill computed being overstated, right? And this will not faithfully represent the consolidated financial position of ABI. And they said the increase in the fair value is 50 million. So if they will not fair value the net assets there, goodwill would be overstated by 50 million, which would not will not make the financial position be faithfully represented here.
Okay, thank you, Korede. You've really touched it. IFRS 3 requires that At the date of acquisition of an acquiree, the assets and liabilities should be measured at fair value, save for about 4 or 5 items that are within the scope of specific standards. And the reason the IFRS 3 requires this is to ensure that there is what we call proper purchase price allocation. In other words, to ensure that the residual amount which is going to goodwill is properly calculated. If the assets and liabilities of the acquirees are not properly measured at fair value at the date of acquisition, given that the consideration is properly measured at fair value, then goodwill, which is the residual amount at the end of the day, will be wrongly calculated. So to avoid that, that has to be done. Just like you have rightly said, what we have here is a case of upward fair value adjustment. Not recognizing this could mean that the goodwill that arose on the acquisition of that subsidiary will have been overstated. And if it is gain from bargain purchase, are we together, that arose, that too will have been inappropriately stated in the financial statement. So that has to be done. But beyond that, look at the last statement there. It's an arbitrary calculation. It's not an arbitrary calculation. It is not an arbitrary calculation. You need 3 items to calculate goodwill. You all know that. The consideration which has to be measured at fair value. People were saying fair value was arbitrary, could not be measured until IFRS 13 was issued in 2011 and it became effective in 2013. It was to provide a guide when it was issued. The second one is the assets and liabilities being measured at fair value. Again, that is not arbitrary. The third one is the NCI, where you have the option of measuring at fair value or using the NCI share of the proportion of the net asset at the date of acquisition. What is arbitrary there? Not. But it says in the context of performance evaluation of the entity, that goodwill is of no use. It is of importance. It is of importance because it forms part of the asset you will have in the statement of financial position, the group statement of financial position. Then secondly, all the other assets and liabilities of the acquiree, if they are not properly stated at fair value, again, that will have impact on the performance, on the position rather. But beyond that, performance. Why statement of financial position looks at position. Statement of P&L and OCI looks at performance. I hope we are all aware of that. Statement of profit or loss, yes, and other comprehensive income looks at what? Performance. And not measuring the assets and liability at fair value. To what extent could it affect statement of performance, which is statement of P&L and OCI? It could affect it in the sense that, assuming this upward 50 million, upward adjustment of 50 million is on building, right? And that building is not adjusted upward to reflect this 50 million. It means depreciation that is charged based in the group account. I'm not talking of the individual financial statement of that subsidiary. In the group account will not be properly stated, and the group profit will be overstated. So to that extent, it affects performance. To that extent, it affects performance. So that is another point that needs to be mentioned. And you conclude here. Okay, Loretta. Loretta, go ahead. Loretta, go ahead. We cannot hear you. We can't hear you. You are still muted, Loretta. Unmute yourself and speak. Okay. Kilani, can you go ahead?
Hello, sir.
Sir.
Okay, go ahead, Loretta.
Hello? Okay, sir.
Go ahead.
I just wanted to say that under the part that says professional marks will be awarded in question 2 for application of ethical principles. Okay, based on the idea of the director who says that goodwill is an arbitrary calculation and it's meaningless and all that, could I just state that the director lacks professional competence? Would that be like a point one can develop?
Okay. Of course, he lacks professional competence to make that statement because he doesn't know what he's talking about. But you don't need to dwell much on that in the professional ethics part of the question. Because what else are you developing there? He lacks the professional quality. He's not talking, he may not be an accountant. So you can say that that statement, many of the statements that this director made shows that he's not a professional accountant and he lacks the professional content. But don't waste too much time elaborating on that. Did you get that?
Yes, I did. Thank you, sir.
Okay. Kilani?
Okay, sir. In addition to that, is it a point for us to say, okay, the goodwill tells more about the reputation of the company? So saying the goodwill is meaningless. So
the goodwill does.
If we are to, it tells about the good reputation of the entity. So if we fail to calculate based on the fair value, that means we are shorting the good reputation to be recognized, the good reputation that the entity has made over the years to be represented or be presented in its financial position. So can we add that to the point?
No, goodwill does not necessarily tell about the reputation of an entity. It does not necessarily tell. It does not necessarily tell. If I thought there's something that does that, it is brand, not goodwill. Okay. So you don't need to add that point. You don't need to add that point. Okay. Is that clear?
Yes, sir. Yes, sir.
Okay. You and Loretta can lower your hand. Eitayo Adeshewa. Go ahead. Eitayo Adeshewa. Oh, your hand is, you've disappeared. I can't see you again. Afis Moraina. Afis Moraina.
Yes, actually, I don't have a question. I want to just call our attention to the time now. We have spent over 1 hour, like as it is now, of which we actually need to like finish this question that you sent to us. Maybe we need to start allocating time to this question so that we don't waste more time on it, and we need to finish as I went due.
Okay, thank you for reminding us on that. My plan is not more than 1 hour for this question. So we spent more than one. Okay, we started around 10 minutes past. So we have 2 minutes to finish this question. Thank you. Okay. We talked about that. The third part, goodwill impairment calculation. Finally, when preparing the annual impairment test of goodwill arising on other subsidiary, the director has suggested that the accountant is flexible in the assumption used in the calculation of future expected cash flow, so that no impairment of goodwill arises and that they are, is flexible so that no impairment, that is ethics. We'll discuss it both under accounting and ethical implication. And that the accountant should use a discount rate which reflects risk for which future cash flows have already been adjusted. He has indicated that it will support salary increase. Okay, the accounting implication is that I-36 is being tested here. And what is being examined here is how to calculate impairment, but specifically, how do you determine the cash flows to be used, and how do you determine the discount rate to be used? Of course, I-36 tells you that in determining the cash flow, you consider the cash inflow, the asset will generate, the cash outflows that will be incurred to maintain the asset, and the terminal value, if any. And it gives you a guide in terms of what should be used, what should be taken into consideration. So you don't walk to the answer. What the director is suggesting here is walking to the answer so that you use a cash flow that will make you not to have impairment. You don't do that. Now, the discount rate is another thing that IAS 36 talks about. It tells us how the discount rate should be computed. And specifically, it says a risk that has already been adjusted in the cash flow should not be adjusted in the discount rate. Specifically, IAS 36 mentions that. So there are some risks, you adjust them in the discount rate. There are some risks, you adjust them in the cash flows. But never adjust a risk that has been adjusted in the cash flow, also in the discount rate. It will amount to double counting and it will be counterproductive. But here what the director is saying is that the discount rate should already reflect the risk that has already been adjusted in the cash flow, which is contrary. So you need to state all this and conclude from the accounting point of view. Like I've said before, when you are doing the professional ethics part of this question, you should do it after you've written each one of those 3 sections. You've addressed the first one, accounting implication. You've addressed the second one, accounting implication. You've addressed the third one, accounting implication. Professional ethics should be written together. And in writing the professional ethics, you should point out some of the things that the director has said that are not right in the question. So starting from the first one, harmful to the business, IFRS doesn't. Kilani, your hand is up again.
Yes, sir. I just want to talk about the rate that you are talking about, because the way I understand the question, that scenario, are they the rate that which you are using to calculate that value in use, or what rate are they doing so that when you are doing that impairment? Okay.
Wait,
Okay.
What do
Sir.
you use discount rate for?
Okay.
Remember, your
Sir.
recoverable amount is higher of fair value, less cost of disposal,
Yes.
of disposal, and value in use. The value in use is what I was discussing all along, that requires cash flow and the discount rate. It's the discount rate you will use to discount the cash flow to get value in use I was talking about.
Okay,
So
sir.
a number of things. Okay, finish your statement.
What I'm saying is, the rate I think we are expected to use the rate that reflect the market situation, market risk. Is that what they are trying to say, that the director is trying to?
The standard says use the rate that reflect the risk inherent in the assets. That is what our statistics say. The rate that reflect the risk inherent in that asset. But risk, there are different risks. If there is one of the things you can adjust in the cash flow is the volatility of the cash flows. The volatility of the cash flows. If you have estimated your cash flow, you may say that because of this volatility, you want to adjust the cash flow down to reflect the risk that these cash flows are uncertain. If you have adjusted the cash flow down to reflect that the cash flow are uncertain due to the volatility of the business environment, that very risk, you should not adjust it again, the discount rate. That is the point. IAS 36 says that. But what the man said is contrary to the requirement of IAS 36. Anyway,
I'm okay, sir.
On the professional IT side, the man made so many statements that are wrong. You must touch on each of those statements. You must touch on each of those statements. It feels that the transaction disclosed it will be harmful to the business, although that may be due to lack of knowledge, but you need to let him know. He may not be doing that due to the fact that he's trying to be malicious. But you can talk about the fact that harmful to the business is not a requirement. In fact, I told you 15 days ago that complying with the standard when you are preparing financial statement amounts to acting ethically. Not complying amounts to acting unethically. So if the standard does not give you the permission to hide the information because you believe it is harmful, and you are doing that way, amount to acting unethically because you are not complying with the requirement of IAS 24. And again, he said non-disclosure is relevant as many entities undertakes related party disclosure without disclosing them. Again, that is a statement that is not right, that you must touch in your professional ethics part. Again, saying that I will not disclose anything other than assets and liabilities when it comes to segment information is a statement that you need to touch when you are disclosing impairment. Again, I mean, when you are discussing professional ethics, again, saying that the accountant should not provide, should not impair the receivable, again, is something you need to touch. It's a statement that is not correct. You need to touch on that. And again, he now said something. Threatening the accountant that he must not discuss it with anybody about the creditworthiness of all right. It's a statement you equally need to touch. You should not remind the director that he should not threaten the accountant. And again, he should not have said that statement. That statement is something you need to touch on. The reason, so all the other statements he made here that are not right, you equally need to touch on them. Then there is a place where he talks about salary increase. Again, that is trying to, which word should I use? Saying that if you keep your mouth shut.
Right.
Intimidation.
Self-interest.
So meaning that if you keep your mouth shut, we'll consider you for salary increase. Again, that is not something that should have been said. You need to touch on all this and state the fact that those things are not right. Then turn to the accountant and talk to the accountant, right? In talking to the accountant, you know, I told you last week what you must do. Let the accountant know that he has to do the right thing. He's a professional. He must act ethically. What he needs to do in terms of the step I gave to you last week is he should go back and discuss comprehensively with this director to let him see reasons. If the director is still training, not seeing reason, he should take note of all the discussion he's having with him. He should speak to the other directors in the business. Speaking to the other directors in the business, if they feel, well, you know that thing requires courage. It requires courage, Joe. It does. Because of the fear of losing your job, it does. So talk to them, hear what they will say. Again, if what you are hearing from them is not palatable, then consider the other courses of action open to you. One which is seek professional advice from ACCA, hotline, get across to them, seek legal advice. But at the end of the day, you may want to throw in towel and say you are no longer interested. But that should be the last option. I'm not saying do that in your place of work so that you don't lose your means of livelihood, but that should be the last option. All those things, you should be able to state them in the question. So that is all about that. Any question? That is all about that. Any other question? In the absence of any question, then let's go to this other question. This is a typical question 1, and I would like someone to help us read this. Typical question 1. I would like someone to help me read this. Hello?
Okay.
Can you hear me?
Question B.
What?
I call it question B, but it's typical question 1 in the exam, past exam question 1.
Okay.
Go ahead.
What?
The following are extracts from the consolidated financial statement of the Moss Group. We have the group statement of profit or loss for the year, the revenue, cost of sales, gross profit, operating expenses, share of profit of associates, and profit before tax. We also have the extracts from the group statement of financial position, where we have the inventories, trade receivables, trade payables. So the following information is also relevant to the year ended 30th September 20x8. Pension scheme. Moss operates a defined benefit scheme. a service cost component of $24 million has been included within operating expenses. The remeasurement component for the year was a gain of $3 million. Benefits paid out of the scheme were $31 million. Contribution into the scheme by MOS were $15 million. Goodwill. Goodwill was reviewed for impairment at the reporting date. Impairment arose of $10 million in the current year. PPE. PPE at 30th September 20x8 included cash additions of $134 million. Depreciation charged during the year was $99 million, and an impairment loss of $43 million was recognized. Prior to the impairment, the group had a balance on the revaluation surplus of $50 million, of which $20 million related to PPE impaired in the current year. Inventory. Goods were purchased for dinar 8 million cash when the exchange rate was $1 to 5 dinar. Most had not managed to sell the goods at 30th September 20x8, and the net realizable value was estimated to be 60 million dinar at 30th September 20x8. The exchange rate at this date was 6 dinar to $1. The inventory has been correctly valued at 30th September 20x8, with both the exchange difference and impairment correctly included within cost of sales. Changes to group structure. During the year ended 30th September 20x8, MOS acquired a 60% subsidiary, Davenport, and also sold all of its equity interest in Baham for cash. The consideration for Davenport consisted of a share-for-share exchange together with some cash payable in 2 years. 80% of the equity shares of Baham had been acquired several years ago, but MOS has decided to sell as the performance of Baham had been poor for a number of years. Consequently, Baham had a substantial overdraft at the disposal date. Baham was unable to pay any dividend during the financial year, but Davenport did pay an interim dividend on 30th September 20x8. Discontinued operations. The directors of MOS wished advice as to whether the disposal of Baham should be treated as a discontinued operation and separately disclosed within the consolidated statement of profit or loss. There are several other subsidiaries which all produce similar products to Baham and operate in a similar geographical area. Additionally, MOS had a 52% equity interest in Watson. Watson had previously issued same options to other entities, which are exercisable in the year ending 30th September 20x9. It is highly likely that these options will be exercised, which would reduce MOS interest to 35%. The directors of MOS require advice as to whether this loss of control will require Watson to be classified as held for sale and reclassified as discontinued. Required. Draft an explanatory note to the directors of MOS, which should include 1. A calculation of cash generated from operations using the indirect method, and 2. An explanation of the specific adjustment required to the group profit before tax to calculate the cash generated from operations. Note: any workings can either be shown in the main body of the explanatory notes or in an appendix to the explanatory notes. B. Explain how the changes to the group structure and dividend would impact upon the consolidated statement of cash flow at 30th September 20S8 for the MOS group. You should not attempt to alter your answer to Part A. C. Advise the directors as to whether Watson should be classified as held for sale and whether both it and Baham should be classified as discontinued operations.
Thank you very much. Thank you. The focus of this question mainly, especially the A part, is on statement of cash flows. And as we started reading, I remember something that, past question, September/December, that somebody posted on the face-to-face class platform, I think about 15 or 16 days ago. I'm sure, I don't know, I think it was Corey that posted that. I don't know how many people have been able to look at that. Here, this examiner in A1 is in A is testing just an extract of the group statement of cash flow. In that other question, it equally tested a statement of cash flow. In fact, and a required extract of statement of cash flows dealing with financing and investing. So now you've seen, I will help the online people to post that question. I'm sure you might have seen it as well, but it's a very nice question to be, I'm just posting it. It's not as if I'm solving it today, but it's a question I will advise all of you to look at. Very good question. Thank you, Korede, for bringing it to our attention. I've posted to everyone. It was there on face-to-face, but in case you missed it, let me repost it on the face-to-face again, in case you miss it. Okay, so let's go straight to this question. Let's go straight to solve this question. You see, I could have asked you to stop. If you look at, explain how the changes in the group structure, that is the B part, the group structure and dividend will impact upon the consolidated statement of cash flows at the 30th September for May. You should not attempt. So that B part is talking to these changes in group structure. That is what it's talking to. Then if you look at the C part, advise the directors as to whether Watson should be classified as held for sale and whether both it and Baham should be classified as discontinued operation, right? Again, that talks to this discontinued operation section. So in solving the A part of the question, we don't need the changes to the group structure and the discontinued operation section to solve the A part of the question. A part is just to prepare group statement of cash flow only as far as operating activity section is concerned. If you look at the requirement, a calculation of cash generated from operation using what? The indirect method. Did we do group statement of cash flow? The answer is yes, we did, right? So without wasting time, it was this Excel we used 15 days ago. So I'm going to, okay, let me borrow from this. Okay, if I need negative sign, I'll come and borrow in case my laptop is not going to. So what we're asked to do in the A part of the question is question 1A. A1, calculation of cash generated from operation, right? Although the A itself is explanatory note to the directors of Moyes. Okay, let me put it that way. Question 1A. 1A. Explanatory note to the directors of Moyes, and the subject is, remember you are writing the directors. The subject is, so you are an accountant, you are writing the director. Cash flows generated from what? Operations. That is the key focus, right? So all these little things counts. So the one is calculation of cash generated from operations using the indirect method. Calculation of cash generated from operations using the indirect method, right? Okay. The figures in which, in thousands or in millions, in millions, in millions. Okay, they are in millions. Okay. Operating activities. Typically, because we are starting with using direct method, we'll start with profit before tax, right? Then we'll now do a number of adjustments. Okay, Kilani, your hand is up.
Sir, I just want to draw your attention to probably to prepare our amendment. Is it possible for them to say we should use direct method? Because this direct method, we have put our mind off that side. And the question could come, is it that the examiner may not likely to test us asking us to use direct method?
Not test it. He will not test it.
Okay, sir.
Okay. Okay, so what is the profit before tax? Please, all of you open your questions so that you'll be able to give me the figure. What is profit before tax?
209.
209.
209. I will use 209, right? Okay, I don't want all this plenty of 00. Okay, adjustments. Now, typically when you are doing statement of cash flows, Dada, go ahead.
Okay, about what Kilani asked, I can remember I saw a question about the use of the direct method, but not calculation, though. Talking about the relevance to the users of the financial statements if you're using indirect or direct, which would be more useful, something like that. So writing off direct method is not like maybe a good advice. Maybe you should just like look through it and know the differences.
Okay, thank you. The question you saw was an ACC question, right?
Yes, sir.
ACC examination question, not Kaplan or BPP questions of their own.
It was from the, what's it called? The resources on the platform.
Okay, in any way, in the study test, I think we explained both the direct and indirect method, and I think I produced the format of the direct method. The only when you say you are preparing statement of cash flow using direct and indirect, the difference lies only in the operating activities section. The investing and financing remains the same. The operating activity, the operating activity section for the direct, you will say cash received from customers, cash payment to employees and suppliers, other cash flow paid. Typically, you leave those. Although for other non-financial institutions such as insurance companies, they have plenty of other items there because in Nigeria they've been forced to use that approach. over 90%. In real life, over 90% of entities use the indirect method, over 90. Despite the fact that IAS 7 itself says the direct method is preferable, nobody uses it. And when it comes to the calculation, I still maintain that examiner is not going to test it. In terms of the reason companies don't use it in real life, and the reason examiner only tests calculation from there is that when you are using the direct method and you are trying to get those 3 cash flows, cash received from customers, right? Cash received from customers. What you are getting in real life is you are deriving it. You are deriving it. Typically in deriving it, the simple way of doing it, depending on the items you have in your statement of financial position, is you will say trade receivable at the beginning of the year, right? Which is trade receivable at the end of last year. Assuming we are dealing with 2021, 2020. Trade receivable in 2020 is the opening trade receivable. Then all your sales during the year, you add it to it. Then you will now remove trade receivable in the current year SFP, which is 2021. That gives you cash received from customer. It's derived. Actual cash received from customer is going to be different from that. And unless you are truly able to get from your accounting record, not from financial statement of working back, from your accounting record, unless you are able to truly get the true cash received from customers, using that direct method is not going to provide any meaningful information. You are just working back to provide something to the users. Hence, the reason companies prefer to use this indirect method, where you start with profit before tax, and you look at non-cash items that have been deducted, you add them back. Non-cash items that have been added, you deduct them, and you make other adjustments as considered necessary. So that would be my contribution in that area based on what you've said. But please go through what you have in the study test, not handouts now, to get further clarity on this. Now, typically when you are preparing statement of cash flow using the indirect method, before you begin to go to any notes, you look at the profit before tax you have used, right? And go through the items right from revenue up to this profit before tax. Look at those items, whether there is a quick win that you want to make here. The quick win is, are there some items on the face of this statement of P&L that have been added or that have been deducted that you believe should be adjusted under that adjustment that I put there? Can you see any here, please? Can you see any here?
Yes, sir.
Share of profit of associates.
Yes, sir.
Okay. Other than that, can we see any? So that I won't come back to this place again. Can we see any other thing? No.
That's just for now.
No.
There's none.
Okay, so share of profit of associates is not the real cash flow as far as you and that associate is concerned. Share of profit of associate is not the real cash flow. It's been added here. What should you do? You should deduct it. The real cash flow as far as you, the reporting entity, and the investee called associate is concerned is one, if there's any additional investment that you made in that associate during the year, and it's cash investment, that will go to investing. Number two, if you dispose part of your interest in the associate during the year, although in the equity method presentation, what you will remove from there, right, is the carrying amount of that portion sold. That is what you will remove, right? Just the same way in PPE. What you remove from PPE is the carrying amount of PPE sold, right? But the real cash flow there is, if that disposal, it is cash disposal, which means you collected cash, Not that they paid you by giving you another asset. Not that they paid you by issuing you shares. Not that they pay you by deferred consideration, which means they will pay you later. If they pay you cash at that point in time in that year, then that is another cash flow that will go under investing. The third one is when you receive dividend from that associate during that year. If you receive dividend from that associate during that year, that is another item. Otherwise, share of profit of associate or share of loss of associate, same as joint venture, is a non-cash item. So I would say share of profit of associate. How much is that figure? You have the question in front of you. I don't want to go back there.
67.
How much?
67.
67.
67.
67. Thank you. Okay, so that is all we can see. Let's now go through the notes. Working capital extract we've been given. I will come back to this. I want this to be the last part of the operating activity. I will come back to it. You know, in the format I gave to you, in the formats in the handout, right? We have profit before tax. We have adjustment, which could be positive, which could be negative. After that, you get to cash flow from operating activity before working capital changes. Excuse me. Then you include the working capital changes. Then you get the next cash flows. Then there are still three items. The last three items include tax paid. That is one. 2, interest paid. Then number 3, contribution into defined benefit plan during the year, if the scheme is funded. If that scheme is not funded, then your cash outflow is the benefit paid during the year. Benefit paid during the year. That will be your cash outflow. So if you look at, aside from working capital changes items that I said I'm coming back to, pension scheme is the next one. Again, I will come back here because this will be the last item. Let me deal with any other thing first. Goodwill, what do they say about that? Goodwill was reviewed for impairment at the reporting. The impairment arose of 10 million in the current year. What should we do to that? Tell me.
We should add it back because it's not cash.
Okay, we should add it back. Sorry, I remember something before. Okay, let me put the goodwill. I will go back to the pension scheme. Goodwill impairment. Sorry. Impairment does not involve movement of cash. Is it not 10? It's 10, right?
Yes, sir.
Yes,
10 million.
We're adding it back because it's been deducted before we arrived at profit before tax of 209. And that does not involve movement of cash. So add it back. Now, let me go back to that pension scheme I left. Remember. You guys did defined post-employment benefit divided into defined benefit plan and defined contribution plan, right?
Yeah.
If anyone.
Sorry, so I was going to ask question on that pension scheme, but you're already talking about it.
Okay, let me finish my talk first. You can lower your hand for now. You did defined contribution plan, defined benefit plan. Defined contribution plan is always very simple. Defined benefit plan, not usually straightforward in terms of how the calculation is done, because you are likely to need an expert called actuary to value what? To value defined benefit plan. However, the examiner knows that you are not actuaries. You guys are not specialists when it comes to actuarial valuation. What is expected of you in SBR is just a simple reconciliation. Your ability to know what is, explain some things. That is all it needs. It's not turning you to actuary. As a result of that, then know the impact or implication of that defined benefit plan in the statement of cash flows. Defined benefit plan, you remember, When you are doing reconciliation of defined benefit plan and you are doing reconciliation of plan assets, if there is plan asset, oftentimes for examination purposes, there is plan asset. I said oftentimes, but not in all cases. There are some things that go in the movement that go to P or L, and there are some things that go to OCI, right?
Yes.
One of the things that goes to L is foreign service cost, past service cost, right?
Yes,
net
sir.
interest cost.
Yes,
Net interest cost is interest expense on the obligation less the interest income on the asset. So that net interest. Those amount they go to P or L, right?
Yes, sir.
Or do they involve
Yes, sir.
cash? The answer is no. They do
No,
not
they
involve
don't
movement
involve
of cash. Because when you look at current service cost, what is the accounting entry? You debit P or L, you credit defined benefit liability. Where is cash? No cash. Past service cost, you do the same thing. Interest cost on the what is it called? On the liability. You debit P or L, you credit liability. Where is cash? No cash. The interest return on the asset. You debit the asset, you credit P or L. Where is cash? No cash. So for that purpose, the service cost component should be added back if they are returning. So let me now read this. Mortgage operating defined benefit scheme. A service cost component of 24 million has been included within operating expenses. Fantastic. That does not involve movement of cash. That is what I've just been explaining. That should be added back. The remeasurement component, where does the remeasurement component go to? Based on what you learned.
OCI.
We started with profit before tax, right? That was before, that is before OCI. Is that not?
Yes.
So anything that goes to OCI has no business relationship with what? With our statement of cash flows under operating activities. It has no business. So that 3 million is erect. Benefit paid out of the scheme were what? 31 million. Ladies and gentlemen, benefit paid. Are we together? If there is a plan asset, if you guys can remember what you did in IS 19, if there is a plan asset, you will remember that that plan asset is out of plan asset and also out of what? Obligation. You remember?
Yes.
That the accounting entry is debit obligation, credit asset. Debit obligation, credit plan asset. So again, that is not the cash outflow from the company. The real outflow from the company is contribution into the scheme, which is that 15. And this is I told you this is the last item. I will show it last. Because the accounting entry for contribution is the company will credit its cash and debit plan asset. It will credit its cash and debit plan asset. That is the real cash flow there. So that which has been deducted, which is service cost component of 24 million, will be added back. So I will say service cost component of defined benefit plan. 24, right? I'm adding it back. Then let me continue. PP.
What of contribution?
That is, I will put it last. I'm coming back there.
Okay.
PP as at September 2008. Remember what I'm doing now is adjustment, but the real cash flow I will put it last. PP as at September 2008 included cash addition of what? 134 million. Okay, that is an item in which part of the statement of cash flows?
Investing.
That is
investing activity.
Yeah, as an outflow of cash. Depreciation charge during the year was 99 million. Of course, the first enemy of the statement of cash is depreciation. So we have to go back and add this one back. And an impairment loss of how much? For 3 million was recognized. Again, we have to go back and add it. Please, in another question you may solve. In another question you may solve. You and I know that not all impairment will hit P or L based on what you learned in IS 36. Is that not correct?
Yes, correct.
Yes, sir.
So pay attention to the question you are solving. There is nothing to suggest that this one did not go to P or L. So we're adding this 43 back. But in another question, based on what you learned in IS 36, you know, it says if the asset that has impaired is an asset that has been previously revalued, and you have revaluation reserve sitting in your OCI, right? In your equity. To the extent of that amount, that impairment loss should not go to P or L. It should go through OCI to reduce that revaluation reserve to zero, right? Did you do that? Can you remember that?
Yes, sir.
Yes, sir.
Yes, we do.
So for such an impairment loss on a PPE carried under revaluation model, that was not taken to P or L, but taken through OCI to reduce that revaluation reserve. Are we going to add it back here? Are we going to add it?
You are going to add the excess of 43 and 20.
Where did you see 20? Wait.
I said 20.
Maybe I've not even read this question. I've not read the question. Prior to the impairment, the group had a balance on the revaluation surplus of 50 million, of which 20 million related to PP impair in the current year. I did not even see this one is here. The scenario I was painting, I did not know that is the scenario here. Exactly the scenario I'm painting. Are we together? It says there is an impairment loss of 43 million, right? Recognized. It now says prior to that impairment, the group had a balance on the revaluation surplus of how much? 50 million, of which 20 million related to PP impair in the current year, right? Of which 20 million related to PP. That means that 43 million, this company will have broken it down into two, right? Into two, 20, which relate to an asset that is carried under revaluation reserve, that has a revaluation reserve of 20, right? That 20 will not have gone to P or L. It will have gone to OCI. From there, it will have gone to revaluation reserve. It is only the balance of 23 that will have gone to P or L. Are we together? So that 23 is the only amount we are adding back. That is exactly what I was trying to explain. I did not know that is. So I would say depreciation. Depreciation is how much? 99, right? Impairments of PP, right? Impairment of PP. Yes. That is 43
minus 20.
Equal 43 minus 20. That gives me 23. Right? Okay, one next. Inventory. What are they saying about inventory? What are they saying? Goods were purchased for 80 million dinars cash when the exchange rate was 1.1 dinars, $1 to 5 dinar. Moyes has not managed to sell the goods at 30th September 2008. To sell the goods at 30th September 2008, right? He has not managed to sell it. And the net realizable value was estimated to be 60 million as at 30th September 2008. The exchange rate at this day was what? $1 to 6 dinar. The inventory has been correctly valued at it, with both the exchange difference and the impairment incorrectly included within what? Correctly included within cost of sale. We are testing our skill. Our skill under IS 21 is being examined here. together, our skill under IS 21 is being examined here. Remember, in IS 21, you were told that for the purpose of translating the balances you have at the end of the year, we differentiate between which and which one. The balances denominated in foreign currency at the end of the year, we differentiate between which one and which one. Remind me.
Pre and post.
No, under IS 21, when you have balances. Monetary and non-monetary. Fantastic. Monetary is one, non-monetary is the other one. If I may ask you, ladies and gentlemen, inventory, will it fall under monetary or under non-monetary?
Non-monetary. Non-monetary.
Inventory is a non-monetary item. I remember when I took the face-to-face class. When I took the face-to-face class, I drew a diagram. And that diagram, I think I brought into the slide by way of additional slide that day. I remember. Although not everybody was in that class. So I did a diagram, monetary on the left, non-monetary on the right. You know non-monetary on the right, yes. That non-monetary, I further divided it into two. What are the two subclassifications of non-monetary? For the purpose of IS 21,
those carrying that historical cost.
Fantastic. And the second
carry
one,
that historical
at historical and fair value.
The fair
value. Yes. The second one is those carried at fair value, right? Okay.
Okay.
Inventory, according to IAS 21, should be measured at what value? Remind me. Inventory.
Lower of cost or net realizable value.
Fantastic. The lower of cost and net realizable value, whichever of the two is lower, right? The inventory we have here at the end of the year, is it carried at cost or is it carried at net realizable value?
It is carried at net realizable value.
At the end of the year. Net realizable value at the end of the year.
Fantastic. It has to be the net realizable value at the end of the year. Where will you put it? Will you put it as non-monetary item measured at cost, or will you put it as non-monetary item measured at fair value? Specifically, I mentioned inventory that day. Remind me.
Non-monetary item measured at net realizable value.
At fair value.
At fair value. Even though, hold on. Thank you. I've heard you. Even though net realizable value, according to IFRS 13, is not synonymous with what? Fair value, right? But what you were told that day is that, at least for the purpose of grouping, inventory that is carried at net realizable value, because net realizable value is lower than cost, should be grouped under those measured at what? At fair value. The next thing then is, what you were told then is that those items that are measured at fair value, that are non-monetary items, you should use exchange rate at the date of determining the fair value to translate them, right? That is with regards to the rate. That will be the rate at the end of the year in this case, because the net realizable value was determined at the end of the year. The second thing is exchange gain or loss there. Where should it go? P or L and OCI. What you were told then was that it should go to P or L if the difference between the previous carrying amount and that fair value, or the difference between cost and net realizable value, goes to P or L. Or if that difference in fair value, changes in fair value, go to where? OCI, then the exchange gain or loss on issue equally go to where? OCI. When net realizable value is lower than cost, the difference, where do we take it to according to IS2? P or L, right? P or L. Then the exchange difference on that will have followed it to where? P or L, right? And that exchange difference does not involve movement of cash. All we need to determine now is that exchange difference, so that if it's a gain, we will deduct it. If it's a loss, we will add it back. That is what we are about to do now. But ladies and gentlemen, what type of inventory will still be denominated in foreign currency? I recall when I took QIS 21, I mentioned that you operate in Nigeria, you bought inventory from US. If you have brought that inventory to Nigeria, that inventory is no longer denominated in foreign currency. Take note of that. However, an inventory will still be said to be denominated in foreign currency if you were operating in Nigeria, you bought that inventory in US, and you left it in that US because you want to sell it there through your branch. You've never brought it to Nigeria, where your currency is Naira. That inventory is still there in US. That type of inventory is still denominated in what? In foreign currency. I feel I should mention that just to quickly revise IS 21. Okay, so I would say on this inventory, is it going to be a loss or is it going to be a gain? Look at it.
Loss.
At the end of the year, 60 million divided by 50 million dinars, right, is the net realizable value, divided by 6. Divided by 6, what would that give you?
$10 million.
That will give you 10. Is that not?
Yes, $10 million.
Okay. Then, at the day it was purchased, it was 80, right? And exchange rate as at that day was 5. 80 divided by 5 will have given you how much?
$16 million.
$16 million, right? That means at the day it was purchased, prior to retranslation at the end of the year, the dollar amount in the book is what? Is 16 million. But at the end of the year, this thing has reduced to how much? In dollar terms, it has reduced to $10 million. That difference of 6, are we together? You know, it consists of 2 components. That 6 consists of 2 components. Number 1, the reduction from cost to net realizable value, which goes to P&L. Number 2, the exchange difference component, which has equally gone to P&L. Do we need to separate that 6 into exchange difference component and reduction in value component? The answer is no, it's not required. So I will just say loss on inventory. Are we together? I will open a big bracket, open a small one, and that small one, I will say 60 divided by 6. That is what gave us 10. Oh, by 6, yes. That is 60 dinars. Oh, sorry, 60 million dinars, right? I will now say minus, open another small bracket, 80 million dinars divided by 5. I will close the big bracket. Then the difference is 10 minus what? Minus 16. Comfort, your hand is up. Go ahead. Comfort.
Yes, I'm with you, sir.
So,
It's not clear why we are recognizing the exchange rate on this revaluation gain in P or L. I understand that inventory is measured at cost, lower of cost than net realizable value, but you've just explained now that because we are using net realizable value for this particular asset, that we should group it as though we are using revaluation model to revalue the asset. And if that is the case, my understanding is that any revaluation gain or loss should be recognized in OCI, as well as the exchange difference arising from that revaluation gain or loss. So I don't understand why we are not recognizing it in P or L. Can you give that explanation again, please?
Okay, comfort. When you say your understanding is that any revaluation gain or loss should go to where? OCI, together with the exchange difference relating to that. Under which standard did you hear what you just said? Under which accounting standard did you hear that? First, deal with any revaluation gain or loss should go to OCI. Under which, before we talk about exchange difference, under which accounting standard did you hear that? Comfort, unmute yourself and speak. Comfort. I hope you guys can hear me. Okay, Comfort, you are not willing to speak. I hope you can hear me. Someone should confirm that you can hear me.
Yes, sir, we can hear you, sir. We can hear you.
Okay, Comfort. That statement you made is a general statement and it's dangerous. That any revaluation gain or loss should go to OCI. It's a general overreaching statement that shouldn't be made. You have to now tell us which standard says that. Let me tell you. IS 40 says when you use fair value model for investment property, fair value gain or loss should go to P or L. That is what IS 40 says. IS 16 says when you use revaluation model, initial revaluation gain should go to where? Revaluation reserve through OCI. Initial revaluation loss should go to where? P or L. Subsequent revaluation gain should go to revaluation reserve through OCI, unless there's been any revaluation loss before, and to the extent of that amount, it goes to P or L. And just like that for the evaluation loss. Can you see the two standards are not saying the same thing? You go to IS 38, intangible asset. It says exactly what IS 16 says, right? You go to financial instrument, investment in equity, or investment in fair value through OCI. Investment in equity at fair value through P or L. Fair value gain or loss, where does it go to? P or L. Investment in fair value through OCI, in equity at fair value through OCI. Fair value gain or loss, where does it go to? Fair value reserve through OCI. Can you say that standard is saying another thing? So you can't make a statement generally. You have to say which standard says that. So fair value gain or loss is not treated the same way. It depends on which standard deals with that. Now, having known that, having understood that, we now come back to IS 21. When you now have an item that is measured at fair value gain or loss, you have it. Exchange rate component of that fair value gain or loss, where does it go to? Wherever the fair value gain or loss goes to is where the exchange difference should go to. That was what we learned in IS 21. And I've explained that with regards to now inventory, that the reduction in the value of that inventory from cost to net realizable value, which is not fair value change per se, should go to where? P or L. The exchange difference on it should follow it. IS 21 is not telling you which fair value gain or loss should go to P or L, or which one should go to OCI. It is the standard that deals with the individual item that will have told you that. But what IS21 is simply telling you is that that exchange difference you have, if it relates to an item that is measured at fair value, wherever the fair value gain or loss goes to is where the exchange difference should go to. That is the only thing IS21 tells us. So don't forget that. Don't forget that. People have raised their hand before. I'm sure they've lowered it. I don't think there's any other thing. I believe I've handled all items, right? That inventory is the last one. Kelani, your hand is up.
So
let
if
me
I
stop.
get you right, now is that like this inventory, you know, the inventory is being recognized, the fair value of it, so goes to OCI. So that's why we are adding this one back, the loss on that inventory. So it's supposed to be recognized. So this is cash flow. So we need to add it back. That is the reason why we are treating this here in particular. So this also applies to every other exchange difference that we may have. The standard that is applicable to that particular item, maybe if it is PPE. So as PPE now, is this with IS 16. So if the revaluation gain is being treated under OCI, so if we have the exchange difference on that particular PPE, so it will be reflected in the exchange difference will determine that the treatment of that PPE will determine where we are going to record that and exchange difference into. Do I get you right?
You say so many things, Kelani. But the first statement you made wasn't what I said, though. You mentioned OCI here. I didn't take anything to OCI on inventory.
Now, what I'm saying is the reason why we are adding it back.
Yes.
Yeah.
Was that a slip of tongue?
The reason why we are adding that loss on inventory. We are adding loss on inventory because it's not a non-cash item.
It has gone to P or L. It's a non-cash item. It's a non-cash item that's gone into P or L. But you mentioned OCI. Was that a slip of tongue? Because I never mentioned
what I mean is because this is inventory. Assuming we are dealing with another items that revaluation different supposed to be a OCI item. So that means the exchange difference to be treated probably is going to be OCI, that we are going to recognize that exchange difference.
It will not, that one will not affect our statement of cash flow.
Yes, that's what I'm saying.
That one will not, just like initial revaluation gain on building, that initial revaluation gain will have gone to where? OCI. From there, it goes to revaluation. Exchange difference on it will have followed it to OCI and will have followed it to revaluation reserve. That one has no business with our statement of cash flows. I'm not going to add it back.
Okay, so.
Comfort, your hand is up.
I had network issues. Immediately I asked my question, I got disconnected. I just came back into the class now.
I've responded to your question comprehensively. My advice is listen to the portion of the video. This is 11:140 something. So just time that portion because I comprehensively address your question. Latif, Babatunde.
Okay, sir. Clarification. Did you say from the cost is 80 million?
You are going up and on. Latif, you are going up and on.
Now, sir.
I don't know. I'm sure it's your network. It's going off and on.
Okay.
Can you guys hear him well?
Not... I can't. No, we can't hear him.
maybe you speak again. Let's see whether we can hear you. I think something is wrong with your network.
Okay, is it not clear now? Is it clear now?
It's better now. Oh, yeah, speak.
Okay, my question is that the question for the first country, then 60 million for the next, then we have 20. My question is that and the question told us that that difference represent both exchange difference and impairments. But we only consider exchange difference here, which is 6 million out of that 20 million difference. Where are we going to put the remaining balance?
Babatunde, where did you get 20 million? The 20 million is in currency dinars. Have you forgotten?
Okay.
The difference between 80 and 60 is in currency dinar currency. We translate. If we've translated, so that 6 represent the translation of that difference, including the exchange difference. Is that clear? Okay, I believe that is clear. Elizabeth, go ahead.
Lisa, all right, sir. In essence, what you're saying is that nothing on OCI will enter here. Everything that we adjusted here is from P&L, right?
Items that went to P&L. Items that went to P&L that do not involve movement of cash are the one we are
adjusting. Okay. Okay, thank you.
Okay, so I've got the subheading. You can lower your hand. Let's now go and deal with working capital changes. Let's deal with working capital changes. So I call this one, okay, no. I need to add 209 and I'm sure that thing will not add well. Yes. I think I need to say this plus this. This net cash flows from operating activities before working capital changes. Okay, then let's deal with working capital changes. So those inventory, receivable, and payable that have left, we now want to deal with them, right? Let's go back there. Inventory, what is happening there? Inventory in 2007, 20S7, which was last year, was 165. In 20S8, is how much? 126, right? It's a reduction. Yes. It's a decrease. It's a decrease, right?
Yes, sir.
Is it not a decrease?
It's a decrease.
Okay. Yes, it is. Decrease in inventory ideally should be an inflow of cash. Is that not?
Yes, sir. Yes, sir.
Decrease in an. Okay. But there is a but that I want to draw your attention to. But before then, Tosin, can you go ahead and speak?
I just want to ask that maybe this contribution payment, are we not going to consider it again? I say you come back to it.
I'll come back last. After I'm there with working capital changes, I'm coming back. Okay. Ladies and gentlemen, that inventory, are we together? That we considered? Are we together? That has that loss. What is the accounting entry for that loss? You know, when we say increase or decrease in inventory, we want to derive the true cash movement. Is that not what we want to do? We want to derive the true cash movement. 165 minus 126, what does it give to you? 165 minus 126, what?
39.
39. Okay. You know, without doing anything, if you take that 39, you mean that is the cash movement in inventory, which is an inflow of cash. But is that correct? Given that there is also another movement in inventory that does not involve cash, which is that 6. Without plugging that 6, you will be determining incorrect cash movement in inventory. You have to plug in that 6. That 6, you know the 6 I'm talking about, the loss on the inventory, reduction from 80 to 60, translated, which now gave us that 6. How has that 6 affected inventory at the end of the year? It has reduced it because it's a loss, right? The accounting entry is that they've debited P or L, they've credited inventory to reduce it. You agree with me? They've debited P or L, they've credited inventory to reduce it. Meaning that the inventory at the end of the year will not have been 126. It will not have been 126 if not for that reduction of 6 that does not involve movement of cash. What should we do? Let's take that inventory to what it will have been if not for that reduction, so that we'll be able to determine the true cash flow. We can do this by way of working. We can do this by way of T account. T account is not susceptible to any error. But I will not use T account unless you force me to use it. So I'm going to say reduction or decrease. Decrease in inventory, right? See, I open the big bracket. I say inventory at the end, 126, right? I will now say plus that 6. I take it to 132, which is what the inventory will have been at the end of the year, if not for that reduction. And minus 165, the inventory at the end of last year, which is the beginning of the year. Then that should take me to what I'm looking for. Equal minus, open another bracket, 126 plus 6, close the bracket, minus 165. It's positive. So it's 33 and not 39. Top where your hand is up.
Yes. So the thing is, I wanted to ask, is it possible to do it by way of working notes, whereby we have opening inventory and we put all those what's it called? The loss on inventory, then we put the closing inventory, then the cash movement in inventory be like a balancing figure. Like, how will it be different in that case? And is it possible to work it that way for this question?
Anyway, whatever you want to use, I've told you use it. Me, in my own days, is T account. If I get confused, I use T account, right? Inventory at the beginning is 165, right? How has this inventory affected what we have? There could have been purchases. Then we now have reduction in what? In inventory, right? This is minus 6, right? That should take us to all things being equal, in the absence of any other thing, then we now say inventory at the end. Inventory at the end. At the end. I left a space there, which is 126. 126. I left a space there. That space is to help me determine the balancing figure, which is the cash. cash flow there. Whatever be the difference represent the cash flows, which is this minus this. That is how else you can do it. And you can also use the account. Tope, are we talking? Does that make sense to you?
Yes, it does. Yeah. Thank you.
Okay, thank you. Odekunle, Odebi.
Yeah. So, Mr. Jamil, this decrease in inventory is not supposed to be a negative. It's not supposed to mean jacket 33 because it's a cash outflow. Okay, the cash is coming. Okay, I get it now.
Selling inventory now.
I get some more cash. Okay, again.
Okay, thank you. Trade receivable, that one is an increase, right? And there is no note that relates to trade receivable. So I would just say increase in trade receivables, right? From how much to how much? 156 to 149. 156 minus 149. I would say equal minus 156 minus 149. So that is 7. That is -7. Payables, what happened? No notes. 215 from 197 to 215. That is an increase as well. I'll say increase in trade payables. 215, 197. 215 minus 197. So I won't put minus in that one because it's a liability. Increase in liability is positive. Reduction in liability is negative. So I will say equal 215 minus what? 197. That is 18. Okay, so again, these are working capital items. Let me sum them up. Equal sum. That is 44, right? 44 plus 304. 44 plus 304. Then that is 348. The last three items, if you have them, this is where I put them. Tax paid, number 1. Interest paid, number 2. Contribution to defined benefit plan, number 3. It's only contribution to defined benefit plan that we have. And that one, I put it here straight. How much is that figure? How much is that figure again? 31. So that is benefit paid.
15.
And it's an outflow of cash, so I have to put it in jackets. So net cash flow from operating activity is 333. 333. This net cash flows from operating activities. So that is what the man is asking for. Only we have only done A1 though. A2 anyway is just an explanation. A2 is just an explanation. It says a calculation of cash generated from an operation using the array method, and then an explanation of the specific adjustment required to the group profit before tax to calculate the cash generated from operation. An explanation of what? The specific adjustment. Can someone tell me what do you think you are expected to be doing here? If you are
For each of the
exam,
adjustments that we made, we should have like a note beside it. I'll just explain.
Explaining what? Explaining what?
Explaining why the depreciation is added, why we are deducting share of profit of associate, the service cost component, everything that was done.
Fantastic. Fantastic. But you know, if you are going to do for every, okay, it says specific adjustment required of group profit. It says specific. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9. It depends. So you may want to group them and talk about them, especially those that are similar. Depreciation does not involve movement of cash. Likewise, so it has been deducted. It does.